Hey landlords and blessed investors, I'm Nicole Purvy and here is your real estate news for the week of May 22nd, 2023. U.S. house prices experienced the largest yearly decline since January 2012, and the number of home sales fell in April as well. According to MSN.com, the median price for an existing home fell by 1.7% from last April to $388,800 this year. The drop is the largest since January 2012, when home prices fell 2%. Although the drop in sales wasn't as bad as what economists on Wall Street had expected. In addition, sales of previously owned homes in the U.S. fell 3.4% in April for the second month in a row, as buyers continue to deal with low levels of home listings and seesaw mortgage rates. Sales were 23.2% lower than April of 2022. Despite home sales dipping in April, some economists believe that the U.S. housing market is in broad recovery. But a combination of issues are making it a slow one. From a lack of new home listings to seesaw mortgage rates, many homeowners are reluctant to sell for two reasons. They may be reluctant to give up on ultra-low mortgage rates secured during the pandemic for a much higher one, and they also don't want to deal with competition. On the other hand, home builders are responding to the inventory crunch by bumping up construction of new homes. After falling 0.8% in March, housing starts, which refer to when a builder starts constructing a home, were back up again in April. Home starts checked in at an estimated annual pace of 1.401 million in April, up 2.2% month over month. Despite this increase, housing starts were down 22.3% on a yearly basis. The monthly uptick in starts came in via increases in both single family, up 1.6%, and multifamily, up 5.2%. These are the 5 hottest real estate markets in the U.S. According to CBS News, a mid-sized town in Georgia about 75 minutes by car from Atlanta is the nation's hottest real estate market as a tide of renters flee pricey cities in search of homes in more affordable places. That's the takeaway from a new Bankrate analysis of nearly 200 housing markets around the country. The personal finance website ranked the top most attractive and active housing markets and found that Gainesville, Georgia was number 1. Bankrate based its ranking on factors such as which cities had the strongest job growth, fastest population growth, largest home value appreciation, lowest unemployment rate, and highest rate of homes for sale. Rounding out the top 5 real estate markets were Knoxville, Tennessee, Fort Myers, Florida, Sarasota, Florida, and Charlotte, North Carolina. Those cities have become particularly attractive to house hunters who have been priced out of expensive metros. The momentum in the housing market has shifted to the Sun Belt and especially to Georgia, the Carolinas, and Florida. While many parts of the U.S. are experiencing price declines, home values have held steady in the Southeast. Bankrate said Gainesville ranked number 1 because homes in the area have appreciated 40% in 1 year, higher than any other location in analysis, and jobs and population in the city grew 15%. Home prices in Gainesville remain relatively affordable. The city's median home price is $375,000 compared to the national median of $430,000, according to Realtor.com. A debt ceiling crisis would hit the housing market like a hurricane. If you're out of the loop, the U.S. has just 10 days to reach a deal to increase the government's self-imposed borrowing limit or trigger an unprecedented default. By the way, the U.S. has never defaulted on its obligations ever. According to Forbes, if the United States breaches the debt ceiling, it could hit the housing market like a natural disaster. Whenever there's a major weather event like a hurricane or snowstorm, the places directly in harm's way see a steep decline in home selling and buying activity. For example, in October 2022, the number of homes that accepted an offer plummeted by over 50% year over year in the 3 Florida metros directly hit by Hurricane Ian, double the national decline. However, those markets mostly recovered by the new year. If the U.S. hits the debt ceiling without a deal in Congress to raise the country's borrowing limit, it would have a similar effect on the housing market. Home sellers and buyers would temporarily back off the market during the turmoil, but will return once the dust settles. Unless the U.S. raises the debt ceiling, the government will run out of money sometime between June and August. And if that happens, the U.S. may miss payments to federal workers, contractors, and vendors, or Social Security recipients to avoid defaulting on its debt. The length and severity of this economic disaster would depend on how long it takes Congress to raise the limit, which hinges on bipartisan cooperation. The economic harm would be most severe in places with a high concentration of federal employees, contractors, vendors, and military personnel, such as Washington, D.C. and Virginia Beach. Anyone who is missing income would likely be reluctant to make a big financial commitment like buying a home. Areas with the highest shares of older people will face the most disruption from missed Social Security payments, such as Florida and Maine. Retirees who rely on Social Security income will be hesitant to spend, which would be a drag on the economies in those places. The slowdown in economic activity may slow down home buying overall. On the other hand, places like Salt Lake City and Minneapolis would be the least affected because they have relatively young populations and few federal employees. The broader housing market could still be affected by swings in mortgage interest rates. Fear about the U.S. defaulting on its debt would push rates up. That's because the potential for a default makes the U.S. investments riskier, including mortgages. However, increased recession risk would decrease mortgage rates. The White House has stated a debt default would result in millions of jobs lost and a decline in economic growth. In this scenario, rates would fall because the Fed would have to lower short-term investment rates to spur economic growth. The last time the debt ceiling was breached was in August 2011. Mortgage rates decreased. Lenders are still losing money on each home loan. According to thehill.com, mortgage lenders again lost money on each loan originated in the first quarter of the year, after recording record losses in the last quarter of 2022, according to data from Mortgage Bankers Association. Independent mortgage banks and mortgage subsidiaries of chartered banks reported a net loss of $1,972 on each loan. Reported losses in the fourth quarter reached more than $2,800 per loan. Here's your real estate investing tip of the week. When choosing a real estate partner, partner with someone who both complements your business acumen and your personality. You have to find both in your partner. It's easy to find someone who only complements your professional needs. For instance, that person has the credit, you have the cash, or vice versa. But you need to consider your work styles and your personalities. Do you complement each other? Are you both control freaks? That's not going to work. If you're a control freak, you may want to partner with someone who is more laid back and likes to play the background. You might not know this, but if you're working with someone to rehab a property, chances are you'll spend more time with that person than your spouse for the next 9 months. You'll need to get along under intense working conditions and high stakes.